Hello. Chapter 6 covers the concept of simple pricing. So we're going to be talking about price elasticity of demand in this chapter and also income elasticity of demand. And at the end, we talk about cross price elasticity of demand. All right, so let's take a look at this simple pricing. So a lot of times in economics, in order to explain a concept, they have to make assumptions to simplify things. So in the simple pricing, with simple pricing, we're going to assume one firm, one product, and one price. So profit is going to equal the price minus the cost times the quantity. Okay, so if you want to calculate profit, simply price minus the cost times the quantity. Now, think about what firms typically do when they a lot of firms focus on the quantity or the cost, but not the price when thinking about profits. So if you think about, most firms will think, first of all, oh, well, we should try to increase our costs or decrease our costs. We should decrease our costs to increase our profits, or sell more to increase our profits. We talked about that marginal revenue in chapter 4. But a lot of times companies can simply increase their profits by increasing prices. And they're doing that now, since with inflation being what it is today, being an issue as of spring 2022, a lot of companies are increasing their prices to pass along increased costs. But anyway, getting back to this, one way to increase profits is simply to increase prices. How much that increases prices, if at all, increases profits, if at all, depends on elasticity of demand. So that's the focus of chapter 6 is elasticity of demand, or what we call price elasticity of demand. And that is going to dictate how inelastic your demand is going to dictate how much your profits will increase when you increase prices. Okay, so let's take a look at demand. So first of all, let's talk about the demand curve. So if you refer to pages 68 to 70, look at page 70 in particular. That's in section 6.3. They show the demand curve. So if you take a look at that demand curve, you see that the demand curve is downward sloping. The reason why the demand curve is downward sloping is because of the law of demand. And the law of demand states that as prices increase, the quantity demanded will decrease, and vice versa. So if you increase prices, the quantity demanded is going to decrease. If you decrease prices, the quantity demanded is going to increase. Now, this is important right here. When I say the quantity demanded, that's a movement along the curve. Okay, so only a change in price can cause the only thing that causes a movement along the curve is a change in the price. All these other factors that we're going to be talking about in a later chapter, such as changing consumer expectations, would be one of them, the price of substitutes. So these factors cause the demand curve to actually shift to the right or to the left. That's called a change in demand. But when the price increases or decreases, that causes a change in the quantity demanded, which is a movement along the curve. All right, so that's going to be important in a later chapter too, so make sure you understand that. All right, so all other factors except price will cause a change in demand. That's a shift in the curve. That's discussed in chapter 8. But in this chapter, we're discussing how price changes cause a change in the quantity demanded, which is a movement along the curve. All right, so remember in chapter 4, we talked about marginal analysis. Lower the price or sell more if marginal revenue is greater than marginal cost, and you could raise the price or sell less if marginal revenue is less than marginal cost. But it's impossible to estimate this marginal revenue. This marginal analysis is really difficult to do in the real world. Instead, we use elasticity. So price elasticity is simply a way to estimate marginal revenue. Let's go down to this price elasticity of demand section. All right, so in section 6.3, we're going to look at the price elasticity of demand. Okay, so what that is a change in the quantity demanded as a result of the change in a price. Okay, so the formula is the elasticity of demand, E, equals the percent change in quantity demanded divided by the percent change in the price. All right, so just to repeat that, the formula for the elasticity of demand, or price elasticity of demand, is taking the percent change in the quantity demanded, that's the numerator, divided by the percent change in price. Now, this comes out to be a negative number. Always, you just disregard the negative number. Okay, and so that's why we have this absolute value here. So if the absolute value of E equals 1, then demand, let me skip down here. If it equals 1, demand is unit elastic. That means the graph is looking, well, the graph looks like, here, let me show you. On page 70, here's your demand curve. And this is just showing at different prices, different quantities are being demanded. So this is a unit elastic demand curve. The slope of this curve, if you increase price, demand is going to increase exactly. If you increase price, demand will decrease by the same amount. Like conversely, if you decrease price, demand will increase by the same amount. So it's called unit elastic. The slope of this curve at this particular slope is unit elastic. A change in the quantity demanded a change in the price is going to bring about a same change in the quantity demanded. Okay, however, if you have a situation where okay, I'm not sure what happened there, but let me share the screen again. Oh. Now I gotta find, hang on a second. Okay, sorry about that. So if you have a situation where demand is elastic, if E is greater than 1, that's telling us that demand is elastic. So let's look at this. If the change in the quantity demanded is greater than the change in price, so what that means is, it's kind of, the way to think of this is backwards. If you, for example, if you change the price, obviously that's the price change is what's happening first, the quantity demanded is the result. So if you change the price and the quantity demanded, the change in the quantity demanded is greater than the change in price, your elasticity is going to be greater than 1 because your numerator is greater than your denominator. So if the absolute value of E is greater than 1, then demand is elastic. So what does that mean? That means that we're going to have a really flat curve. And so if the curve is really flat, then if you decrease the price, the quantity demanded is going to increase by a whole lot, by much more. Likewise, if you increase the price, the quantity demanded is going to decrease by much more because the curve is really flat. So if demand is elastic, then a change in the price is going to cause a greater change in the quantity demanded. Now, If the demand is inelastic, think of a curve that's really steep, super steep like this. You could have a huge change in the price, but it's not going to change the quantity demanded very much. So if demand, we say that demand is inelastic if E is less than 1. So that means that a change in the quantity demanded is much less than the change in price. In other words, if you change the price, it's going to cause a much smaller change in the quantity demanded. Hardly will affect it at all. And so that's, in that case, demand is inelastic. Okay, so let me give you some real world examples here. Demand for cigarettes, very inelastic. People are going to smoke regardless, right? So that's why, when the government wants to tax something, they'll tax cigarettes. They're not going to tax something like orange juice because people could just substitute out and buy apple juice or grapefruit juice or something else. But they're going to, they tax things where demand is very inelastic, because if you tax cigarettes, raise the price of cigarettes through taxes, people will still buy cigarettes. The demand is not going to go down by very much. So when you have a situation where demand is inelastic, it means that a change in price is not going to affect the change in demand very much. Okay, so note that elasticity is always negative because of the way the formula is set up. Just disregard the negative sign. Okay, so think about the formula now. If you want to increase profits, should you raise prices or should you lower prices? Well, the answer depends on elasticity. So if your demand is very inelastic, you should increase the price, because if you increase the price, your total revenue from that price increase is going to be more than what you've lost in quantity. So in other words, if you increase the price, you're going to increase your total revenue, because the quantity demand is not going to decrease by as much, and the increase in price will be greater. So if you have very inelastic demand and you want to increase your profitability, you should increase your price. That will increase your total revenue. But if you have something that's very elastic, if you have very elastic demand, you should decrease your price to increase total revenue. Because if you decrease your price, the quantity demanded will go up by so much more that your total revenue increases. So I hope I didn't confuse you too much trying to explain that. But if you think about total revenue, if you want to increase your profitability, if demand is inelastic, you want to increase your price. That increases your total revenue. If demand is elastic, you want to decrease your price to increase total revenue. And the reason is because if it's elastic, you have this really small decrease in price, your quantity demand is going to go way up. That increases your total revenue. So it really behooves companies to try to figure out how elastic or inelastic demand is for their products, because then that tells them whether they should increase or decrease price if they want to increase total revenue. And as an example, I remember several years ago, Coca-Cola was, and they announced one of their quarterly reports. Companies give these quarterly reports every quarter. They have these reports on their quarterly earnings report. And so Coke had raised their prices of the 20-ounce Coke from like $1.29 to $1.39 or something. And they said that their revenue increased by a lot more than they thought it would, because they had miscalculated the elasticity of demand. They didn't realize that demand was as inelastic for the 20-ounce bottles of Coke as they thought it was. And so they had this calculation all worked out, and they ended up making more money than they thought they were going to, because demand was more inelastic than they thought. Okay, so getting back to this then, talk here about the taxation. All right, so make sure that you look at this example on page 73. And that is, okay, that's this Coca-Cola example. So it shows you the formula here for elasticity, and the elasticity of demand. Let me show you here on this top line here. So the elasticity of demand, you can look on the book as I say this, but the elasticity of demand, remember, it's the change in quantity divided by the change in price. So what does that actually mean? Well, look at that formula at the top of page 70. It's Q1 minus Q2 divided by Q1 plus Q2. Then you divide that whole thing by P1 minus P2 divided by P1 plus P2. All right, so what they're telling us in this example is that it's a Coca-Cola example, coincidentally, and they've lowered, let's see here, they have lowered their price. A second. They lowered their price from $1.79 to $1.50, and the quantity sold doubled. It went from 210 units to 420 units. So with that information, we're going to calculate the elasticity of demand. Okay, so if you follow along with this example, the elasticity of demand comes out to be 3.8. So it comes out to be negative 3.8. Now it's greater than 1. It's the absolute value. So disregard the negative sign. And so the elasticity is 3.8. So this means that a 1% decrease in the price would lead to a 3.8% increase in demand, and vice versa. So if they increase the price by 1%, it would lead to a 3.8% decrease in demand. So by decreasing their price, their revenue increased by $254. So you can see that in the right here in the where they actually calculate how much their revenue actually increased. So elasticity was 3.8, meaning that demand for Coke is elastic, quite elastic. And so the way you would translate this or interpret this is to say, well, okay, well, a 1% decrease in price then is going to lead to a 3.8% increase in demand. All right, so go ahead and make sure that you look at that formula. So now let's look at some things what are some things that would make demand more elastic? Well, products with close substitutes would make demand more elastic. Excuse me. So for example, think about Apple products versus juice. By that, I mean the company Apple. So there's many products, there's many substitutes for juice. So you can, if they raise the price of orange juice, as I mentioned earlier, you can start drinking apple juice or cranberry juice, tomato juice, what have you. And so if it's really easy to substitute away from one product to another product, that's going to make demand more elastic. My other example, the iPhone. In my opinion, that's pretty inelastic because, of course, you can get an Android, but a lot of people really like the iPhone. So the demand for an Apple iPhone is pretty inelastic. People are pretty loyal to that. There's not a close substitute. Demand for specific brands of cigarettes, people they're loyal to one brand of cigarettes, so demand is very inelastic for that. All right, so the more close substitutes a product has, the more elastic demand will be. Okay, second thing here, the demand for an individual brand versus the aggregate industry demand. So, in other words, the demand for an individual brand is going to be more elastic than the demand for the aggregate demand. So, for example, if they raise, if the price of Peter Pan peanut butter goes up, people are going to probably switch to Skippy peanut butter. So you can easily substitute in between brands. But if the price of peanuts goes up, and all peanut butter goes up, you're still going to buy peanut butter. You see, same with coffee. You might substitute out on different brands if the price goes up on one of them. But if coffee goes up in general, you're still going to buy coffee. So the demand for individual brands is more elastic than for the aggregate brand. Okay, and then in the long run, demand is more elastic. This is because people will change their behavior in the long run and find substitutes. So think about we're facing here to spring of 22, we're facing high gas prices. So demand for gas is pretty inelastic, but it is going to get more elastic in the long run because people will change their behaviors. So right now people are facing, there's kind of they're getting hit, their pocketbooks are getting hit at the or wallets are getting hit at the gas pump because prices have gone up so much. So we're paying it right now, but in the long run, we're paying the higher gas prices right now, but in the long run, people will change their behaviors and their demand will go down for gas because the demand will become more inelastic for gasoline because, for example, people might start buying more electric cars. They might start buying cars with better gas mileage, buy hybrid cars. They may carpool. They won't drive as much, those kinds of things. And so also, let's see, let me give another example. Let's say the price of beef, well, it has been going up. So let's say the price of beef goes up relative to chicken. So you go to the grocery store and you have your menu and you've planned these menus that include beef. You go ahead and buy the beef because you've planned it out. But you're going to change your behavior. And the next time you go to the store, you're going to have more chicken dishes. So that's what they mean by the long run versus the short run, because people will, if the price of something goes up and they've already planned to buy it, they'll go ahead and buy it, but then they're going to change their behavior. And so demand becomes more elastic in the long run. Okay, so these three things make demand more elastic. What makes demand less elastic? Well, products that have a lot of complements have less elastic demand. So for example, iPhone demand it's not, when the iPhone first came out, they had a lot of apps, a lot more apps than the Android. And so all of these apps, which are complements, made demand for these iPhones less elastic. But that's not really so much the case anymore. Also, think about some children's toys with a lot of complements. So I always think about the Barbie doll. I know Barbie dolls aren't really popular anymore, but they were for decades. You could buy a Barbie doll. When my daughter was little, you could buy a Barbie doll for $4 or $5. This is in the late 80s, early 90s. Well, actually in the 90s. You could get a Barbie doll for $5, but it was all the accessories that were so much. So, I mean, there's other toys you can think of, but anything that has complements is going to make demand less elastic for that product. Okay, low cost items have less elastic demand. So that's, going back to the Coke example, not in the book, but the Coke example that I was given when they had their quarterly report. A 20-ounce Coke isn't really that expensive. And so people didn't mind paying a higher price. So if you think about, let's say you went to buy a Coke and Coke had gone up, the price had gone up 20%, say, you're not really going to notice that because a Coke is not that expensive. Or if you're buying chewing gum or mints and they're up 20%, you're not going to notice that. But if you go to Home Depot or Lowe's and you're trying to buy a refrigerator or a washing machine and it's gone up 20%, that's a lot more significant. And so demand is going to be a lot less elastic on a high priced item than a low priced item. All right, so so right here is we're finishing up talking right here. We're finishing up talking about price elasticity of demand. All right, now we're going to talk about income elasticity of demand. These two things are at the end of the book. Not quite as important, but make sure you understand them. So income elasticity of demand, this is when a change in income causes a change in demand. So price elasticity of demand was the change in price causing a change in demand. This is where a change in your income causes a change in demand. So this is positive for normal goods and negative for inferior goods. So what does that mean? A normal good is a good that you're going to buy more of as your income increases. So that's pretty much everything out there. So most goods out there are normal goods. We're going to buy more of them as our income increases. So you have this positive relationship. Inferior goods are something that you're going to buy less of if your income increases. So you have an inverse relationship with inferior goods. Think about ramen noodles, maybe Spam. If you know what Spam is, it's really cheap canned meat that people will eat if they don't have a lot of money. Generic products, those kinds of things. So anything that you would buy more of if you have less income would be an inferior good. Okay. So income elasticity, the relation of demand, the relationship is positive for normal goods. Your income increases, you're going to buy more, and negative for inferior goods. As your income increases, you're going to buy less, or vice versa. Okay, then we have cross price elasticity of demand. This is demand for good A with respect to good B. All right, so let's look at some examples here. So the relationship is positive for substitutes and negative for complements. Okay, so let's do peanut butter and jelly. The price of, let's say peanut butter is good A, jelly is good B. They're complements, right? Peanut butter and jelly go together. So if the price of peanut butter goes up, the demand for jelly is going to go down, because if the price of peanut butter goes up, people are going to buy less peanut butter. Therefore, they're going to demand less jelly. So you see it's negative for complements. Price goes up, but price of one good goes up. Demand for the complement goes down. It's positive for substitutes. Let's go back to the beef and chicken. The price of beef increases, okay? So demand for chicken increases. They're substitutes. Okay, so that's the cross price elasticity of demand. All right, so what did we learn in this chapter? We learned about price elasticity of demand, income elasticity of demand, and cross price elasticity of demand. All right, so there's some math in this, so a little bit more complicated math. Go through the examples in the book, and then you can feel free to come by my office or send me a call, or we can even do a Zoom call or text, whatever. If you want to, if you feel like you need a little bit more explanation for this chapter. So you can feel free to reach out to me with any additional questions you might have. And I'm happy to set up a Zoom call if you want some more clarification. All right, so this is chapter 6, and now you can finish, now you can do the second homework assignment for this textbook. Goodbye, till next time.